This is a Silver Forecast Special Report, where Michael Oliver is doubling down on $200 silver. But that's not the real headline, because if he's right, silver isn't moving higher because of excitement or hype or even simple supply and demand. It's moving because something much larger is starting to break. And once that process begins, price doesn't ask for permission. Over the next 6 months, silver may enter a phase that looks chaotic on the surface. Sharp rallies, sudden sell-offs, violent corrections that shake confidence. We've seen this before: 1979, 2010, 2011. Those pullbacks didn't end the bull market, they defined it. According to Michael Oliver, we are entering a similar phase now, with the most intense pressure building from the mid to late first quarter into the second quarter of 2026.
I expect in the next 6 months, and this is month 1 in the countdown, we're already closing November, we started, so December's month 1. But in the next couple quarters after that November close, I think you'll see silver with sharp sell-offs in the process reach at least 200 and possibly a lot higher in a rampage. Yeah, there'll be a correction in the middle somewhere, probably. There was in 1979, there was a little correction in the middle that fooled people. Same in 2010 to 11, there was a reversal month. There was a fake out, and you exploded more. So sometime, let's say mid to late first quarter, you might get a correction that you could really call a correction. Not what we're seeing today. This is just a quick jerk, okay? But sit back and give it a couple quarters, and I think you'll see that it doesn't just get to what you could call a fair value based on the degradation in the money unit, meaning $200 an ounce or so, but probably overshoot it vastly.
But the most important part of Oliver's outlook is not the number, it's the driver. Silver is not just acting like an industrial metal, it is reasserting itself as a monetary metal, and the pressure pushing silver higher is not coming from mines, it's coming from the global bond market.
And plus there's the other factor that, we haven't talked about, and it's not just that silver's a key industrial metal, it's a monetary metal.
According to Oliver, there is an earthquake forming beneath government bonds, not in one country, but across the system. U.S. Treasuries, Japanese government bonds, UK gilts, markets that were once treated as untouchable are starting to lose structural integrity.
When certain other events outside of the monetary metals occur, like we have an underlying earthquake-type crisis building in some major government bonds, our bonds, Japanese bonds, UK, etc. There's a lot of big bond markets where there's underlying crisis already there, just hasn't ripped open and exposed itself fully. And when that does, that'll create huge waves of doubt and panic and impacts on other markets like the stock market, down, etc.
When government bonds come under real stress, central banks don't stand aside. They intervene. They print. They expand balance sheets aggressively to prevent yields from doing what they naturally want to do. That response doesn't restore confidence. It destroys currency value. And when currencies lose purchasing power, monetary metals
so
don't grind higher.
all these factors can come into play,
They
in which
reprice.
case the central banks go ape, absolutely crazy, trying to save their government bond markets, and therefore printing money, which is the lifeblood of what gold is. Gold is money. You destroy your paper, gold goes up, etc. So I think that's the real underlying major factor in play here, not just the silver supply demand.
Currency debasement, metals reaction, gold moves first. Silver moves harder, because silver sits at the intersection of monetary fear and real-world demand. There is another layer to this: behavior. When stock markets begin to fail, not with one dramatic crash, but with grinding losses and false recoveries, people notice. When retirement accounts decline, when pensions wobble, when portfolios that were supposed to be safe stop acting safe,
We're saying
panic
silver may
spreads
be,
beyond
let's just use the
institutions, it
word
reaches
recalled,
households.
back into some type of a monetary role, because I think already Russia has mentioned it. I think even India is allowing the collateralization of silver to have some type of monetary role. So we may see it being recalled alongside gold.
Yeah, I think so. And you'll see it here and then there. What's going to cause it to be more widespread? The monetization of monetary metals again, the recognition that, gosh, this past very long human lifetime, we have just printed 100 years or so. We've had a central bank here for 110 years that prints and prints in cycles. And it's true in Japan, it's true in Europe, etc. So, and it hasn't worked. And you've got to create, though, probably panic. And you'll never see panic on the face of a Fed governor. Okay, they're always, everything's under control. But I'm talking about the average guy.
That is when metals stop being ignored. That is when they are reconsidered by the public and eventually by policymakers. Michael Oliver also believes the equity market has already completed a topping process,
Because when
not with a single
if
peak,
you impact that
but
stock
with
market in this
distribution.
process, and I think the stock market has been topping since January. It's a laborious, marginally new highs, etc. It's the same thing it did in 2000, same thing it did in 2007, where you make a high, pull back, and make another new high, and everybody thinks, oh, it's going to go forever.
Since January 2025, markets have pushed to marginal new highs while momentum underneath has quietly deteriorated. This kind of topping is invisible in real time. It only becomes obvious after the downside accelerates. According to Oliver, that recognition phase becomes unavoidable late in the first quarter and into the second quarter of 2026. When that happens, confidence doesn't fade slowly. It snaps.
But when that beast rolls over, and I think that's probably you're going to start to see evidence of that the average guy can realize late in the first quarter and especially into the second quarter of next year, where, because it's the only thing people could smile about. Their retirement account. Hey, S&P's up 10, 15%. Oh boy. Meanwhile, gold's up, 100% or whatever, but they ignore that. But if you take that away from them, the average guy who's not really feeling that good about other aspects, financial aspects of his life, then suddenly there's fear. And you inject emotion into it, and that's when you get political ramifications and therefore pressures, even among academicians, to say, hey, this central bank thing hasn't really been working well. It's just been a matter of constant boom-bust cycles, monetary booms, stock market booms thereafter, et cetera, et cetera. And that's when you get the doubt and hence those kind of changes you mentioned. Right now it's just here and there, but it could be far more widespread when these other events unfold. And I think gold and silver know that's underway. The smart money buying it knows something's wrong out there. I want to own real money. And that's what's really the underlying power of these moves.
So this is not a silver price story. $200 silver is not the real bombshell. The real story is that multiple pillars of confidence are being tested at the same time. Government bonds, equities, currencies. Silver sits downstream from all of it. When confidence breaks, silver doesn't need promotion. It doesn't need narratives. It moves because the system leaves it no choice. This is Silver Forecast. Not about chasing excitement, but about recognizing when the visible price no longer reflects the pressure building underneath the market. And if you want our full framework for how silver could unfold through all of 2026, including pullbacks, breakpoints, and confirmation levels, watch the Silver Forecast New Year's special, where we lay out our complete outlook for silver in 2026. That's where the pieces come together. This has been a Silver Forecast special report.